Hello, everyone. I'm Roman Polnar, and on behalf of Hebrew Free Loan Business Circle, I'm excited to welcome you to Food for Thought, which is a series of monthly conversations with experts in our community that have offered to share their knowledge and insight with us. Today, we're going to take on a pretty big topic, one that's on many people's minds about the proposed tax changes, how they might affect you and your business, how to plan ahead, and ultimately how to bulletproof your taxes to withstand IRS scrutiny. But before welcoming our guest and longstanding Business Circle member, Elizabeth Schwiff, I'd like to thank our sponsor, the Hebrew Free Loan of San Francisco, for supporting our Northern California Jewish community for 124 years. And this series is another way to offer resources and support, because each person we're speaking with is a business owner with real-world experience, and they volunteer to share their insight that may help you navigate whatever you may be facing in your own life or business. And for those of you joining us live, feel free to ask questions in the comment section below. Now, today, I'm excited to have this conversation with Elizabeth Schwiff, who is the founder of Schwiff, Levy & Polo, a highly respected CPA firm here in San Francisco that she started in 1989. And over the last 32 years, Schwiff, Levy & Polo has become a trusted full-service CPA firm providing tax consulting and tax filing services for successful individuals, business owners, and they also specialize in international tax issues, as well as disclosures for U.S. citizens living abroad and foreign nationals living and doing business in the U.S. And it goes without saying that Elizabeth is a highly experienced tax professional, and she's also a lifelong learner, having acquired other credentials in addition to being a CPA. She is also a certified fraud examiner, a certified financial planner, personal financial specialist, accredited estate planner, and she even challenged the federal bar exam and is licensed to practice in the federal tax court. There is no better expert to dive into this topic with than Elizabeth Schwiff. So without further ado, I'd like to welcome Elizabeth into conversation. Hi, Elizabeth.
Hi, Roman. Thank you.
Well, thank you for being here.
Pleasure to be here.
So Elizabeth, this is a big topic. And as I mentioned in our introduction, the recently proposed tax changes are a big concern to a lot of people. And a lot of folks wonder, and in many cases, they worry about how these changes might affect them personally, or their businesses and their taxes, especially given the scope of the proposed tax changes. And so I'd like to start by asking you to offer some insight, if you can, into how these proposals might affect our individual taxes as well as our business taxes.
Yeah, so here at the end of April is when we started hearing and getting news about President Biden wanting to change the tax system. And so the numbers that were coming out in the media, they really felt huge, and it was almost like an attack. And so, but when you really take it apart and you start comparing, let me give you the numbers so that you can figure this out for yourself. So there's an American Families Plan, and he says, well, we just need $1.8 trillion for that plan. Those are huge numbers. Mm-hmm. And he said, well, this is going to be paid by tax increases on the higher income individuals. So then he had another plan, the American Jobs Plan. That's $2.3 trillion. Okay, so 1.8 trillion, 2.3 trillion, that's about 4 trillion. Well, the second one he wants to pay for by increasing the corporate tax rate. But then when you hear another stat, this is nothing. The IRS is leaving $1 trillion on the table, uncollected every year. Both of these programs that just sound so huge, they could be collected from people that already owe the money in just 4 years. And so, you just have to put this in perspective. You just get one piece of information and you don't get the other side of this information. And these proposals, if they do pass, they will not be retroactive. Of course, they'll be prospective, and we probably will look at something in 2022.
So there are a couple of things that have come to mind, and I know you've mentioned this in the past, but you just said something about this 1 trillion that is uncollected from individuals, and that the government might as well go after that money first. Can you explain that? That doesn't seem to make sense to me. What do you mean it's uncollected?
Well, what has happened is that, and experienced CPAs really see it's cyclical. And so an administration comes in and they say, oh, we don't want to fund the IRS. So the IRS then doesn't get the funding from Congress. Well, we're at a point now, 10 years into this cycle, where the IRS has lost 71,000 employees. And so people file their tax returns. They say they owe $50,000, maybe more, maybe less. And the IRS knows that they owe it. The taxpayer knows that they owe it, but they don't pay it. It's left on the table, and there is no one to go out and get the money. There's no body, there's no human being that they can send out to collect these unpaid tax return bills that are outstanding. It's $1 trillion a year, and so Biden he wants to invest. He's talking about an investment. He says, I want to invest $80 billion into the IRS over the next 10 years to collect an additional $700 billion. And so, and Biden, he keeps reassuring Americans. He said the burden for these trillions is not on us. It's on the people that are not paying their fair share. They file their tax returns, but then they don't pay. The other thing is he talks about the inequity. And so they want to fix that also. They release tax records, Michael Bloomberg, Jeff Bezos, Warren Buffett, Elon Musk. And you can see these people are not paying any taxes. So there's an inequity going on. And that's what he's trying to fix.
Well, so the way that the proposed taxes, or at least the way that we've been presented with the proposed tax changes, sort of include these two sides, where there's proposal on one side to increase the individual tax rates that we would pay as individuals on the income that we earn. And then the second set of changes that would collect higher tax revenue from the businesses or from companies. Mm-hmm. And for all of our listeners that are either watching us live or will be watching the replay, I imagine this is a big concern, either individually or if they happen to be a business owner, about their business taxes. So there's a lot of questions that I'm hearing from folks about, well, how do we plan ahead? What is likely to happen in the future? So if we just started with the individual tax changes, or at least the proposed tax changes for individuals, what light can you shine on that?
So I did some research, and I actually ran some numbers. So Biden wants to increase the tax rate, the top tax rate, from 37 to 39.6% for households earning $400,000 or more. That's exactly what we had under Obama. And this is only going to apply to the top 1% of the income earners. So these numbers sound like an ouch, but they're really not. So I pulled a tax return of someone that gets compensated in stock, which is taxed at ordinary rates, and their tax return of gross income was 1.7 million. So I then checked and saw what the effective tax rate was on that 1.7 million. It was 24.5%. I mean, we're all used to paying 20%, 24%, and this was on 1.7 million. And so the numbers we hear and read in the news today, they're based on gross income, not net income. We're allowed deductions. And so I also used the Forbes calculator for Biden's proposal. Mm-hmm. And I had to get up to 500,000 for any additional tax in this rate increase from the 37 to 39. And so the additional tax at the $500,000 income was 0.008. If we look at that number, that's almost immaterial in the big scheme of things. So, if you're in the top 1% of the nation, you will feel a little bit, 0.008 you'll feel.
That doesn't sound like as big of a number as a lot of people are fearing in terms of multiple percentage point increases.
Correct. I think again, it's the high income earners. He wants to also tax investment income as ordinary income, but that's if you earn more than $1 million a year. That's 0.3% of all households. So we're not going to be hit with that. He also wants to close some loopholes on that NIT tax, that net investment tax, at 3.8% that you see on your tax return. And so there are inconsistencies in the law right now. There are holes in the law. An example that he wants to close is the S Corp. And so that income, the ordinary income that appears in that box 1 on the K1, right now is just subject to ordinary income, not subject to self-employment income, not subject to Medicare. And so that income he wants to hit with that 3.8%. 3.8% is nothing like self-employment income. It's not even Medicare tax. And so the other things that he wants to do, again, these are for high income earners. He wants to propose another haircut on the itemized deductions. He wants to limit them to 28% for households earning more than $400,000. So you know about the haircut with the $10,000. I think they're trying to play with that also and allow that, but then maybe disallow some others. Another one that he is proposing, I just don't see this one passing, but eliminating the 1031 exchange, the like-kind exchange. And so he wants to give the individual $500,000 tax-free gain and tax anything over that. And I can understand that because I can give you an example of a client of ours that I've watched over the last 25 years. So this is an attorney. He was in practice as an attorney, and then he left law practice, and he started buying property in San Diego. He's up to 25 properties in San Diego. Some of these properties are multi-unit properties. So his portfolio is now about a little over 20 million. So in his case, what he did, he bought his first property, it increased in value, he refinanced, pulled cash out, bought another property, it increased in value, pulled money out, bought another one. Mm-hmm. So all this increase in value has never been taxed. He's also done about 3 or 4 1031 exchanges, always going up and up with more mortgage, no tax. So now he is older, he's in a nursing home. And nursing home, well, 2-3 years and you go on to the next life. So there'll be an estate tax return. This 20 million, he gets over 11 million, estate tax free, no tax. His wife, she also gets this, and he gets a step up in basis. So now the portfolio will come up to $20 million, all tax free. His wife could sell everything and not pay a single dollar of tax and have $20 million in her account. I think that's what they're trying to go after. They're also hitting some estate and gift tax proposals, and this again has to do, it fits right into this client example. They want to get rid of the step up in basis. They want some capital gains in excess of $1 million. For a couple, married couple, it would be 2.5 million. Anything in excess of that, they would want some tax. But there's a problem with that. And the fact sheet that are out there right now from the White House, they don't give enough detail. But the problem is it even constitutional? So you tax the increase in fair market value with an estate tax, and now you don't give them a step up in basis, and now you tax, when they sell, you tax again with income. So it's a double taxation. I don't know. I think they're going to have a problem with passing this one.
So you just went over some of the, I think, biggest areas of worry for individuals, especially those in the higher income phase. What would you say about businesses? I think a lot of folks, especially higher income folks, also are worried about their business taxes going up. What would you say there?
They are. Again, it's because they get 50% of the information. They're not getting 100% of the information. So Biden wants to raise the corporate tax rates from 21 to 28%. Most small businesses are not C Corps, they're S Corps. It's a flow through. But we do have C Corps. And I can tell you the privately held C Corps, they don't pay tax. They are able to have additional expenses. They invest their money. They buy new equipment. They fund a pension plan. They pay more out in salary. And so in the end, the corporation doesn't get taxed. The individuals get taxed on their income, but the corporation doesn't get taxed. So this is really for publicly traded companies. And the publicly traded companies currently, a lot of them are not paying any tax. And this is what he is trying to change. He wants to create a 15% minimum tax on all corporations with book profits, these are publicly traded, of 100 million or more. And the goal is to have all corporations in America pay some tax, a little bit of tax, 15%, something. And he also wants to do something else, and this would be interesting how he would be able to implement this, you know, instead of a carrot, it'll really be a stick. He wants to impose a 10% tax penalty on corporations that ship jobs overseas, when those jobs could be filled by American workers.
So having this brief conversation with you, what I'm hearing from you is that some of these proposed changes that seem detrimental and hurtful might not be so bad after all. Is that a fair assessment?
I believe so. So when you get 50% of the information, then you are able to research and get the other 50% information. If you've got 100% of information in front of you, like what I said, you know, the IRS is leaving $1 trillion on the table. These two plans could be funded in 4 years.
Without further tax increases.
Exactly.
Well, given your experience and the years that you've advised both individuals and businesses, I'm sure you've seen something like this before. What would you tell our listeners in terms of how they can plan ahead, how they should look at the current as well as the future, you know, plans on their individual income, their business income, and how to file their taxes the right way and avoid IRS scrutiny?
Well, you know, the experienced CPAs in our industry, you know, we see this as cyclical. And these are about 10-year cycles. And the pendulum swings, you know, to the left, to the extreme, then to the right, just goes back and forth. And then we've got another issue before we even get to the planning, and that is, what is the probability of success? It's difficult. The Democratic majority is narrow. We will see. Some of this stuff will get passed. There is something that they can use. It's a parliamentary procedure called a budget reconciliation. The last time it was used was when Obama passed the Health Care Act, and he used this particular procedure. And so I would say, wait it out. If you have any really strong opinions about any of these proposals that I mentioned, contact your congressional representative, voice your concerns, give them actual facts and examples of your situation. If you're a member of a trade organization, speak with a person that travels to Washington to advance the interests of your profession. As far as the planning, I would say wait and see. What I have always seen in my whole career, and I've seen a lot of these cycles, is whatever laws are passed, no one can think them through 100%. And so now we've got really intelligent people in the United States. They start taking these apart, and they start coming up with new ways, new methods of planning after the law has passed to minimize that effect. It always happens. And then they call them, oh, well, these are tax holes. Well, these tax holes are going to be in existence for at least 10 years. And so I wouldn't really worry. The area where I'm hearing the specialists talk and address, and they're saying, well, right now we've got the 40% estate tax. Well, you know, we've got 22 million in exemption. So if you were planning to gift anything, this is the year to make the gifts. Before they change the law, before they change the step up in basis. We saw this with that California Prop 19 in the property tax area. There are a lot of parents that were gifting properties to their children to avoid the reassessment in property tax. Same here. If you have properties, if you've got gifts that you are considering making anyway, now's the time to do them. That's a sure planning item that you could do. Also, don't make any disclaimers on any of these estate tax returns. Don't move any of the assets into a B trust or a C trust. Don't take a Q-tip election. Pay the tax, pay the estate tax this year.
So, Elizabeth, sorry, I want to go back for just one step because you just went into an area that some of our listeners might or might not necessarily have a lot of knowledge about, but it's a big area that I hear over and over, which is the estate planning. So for folks who are planning ahead, and this seems to be a separate but parallel to the tax proposals, is the whole exemption of the estate or the amount of estate that can pass avoiding the tax. Are you saying you're fairly confident that the estate tax exemption will be lowered?
I think so. It's really high. How many people do you know that are worth 20, 30 million?
Mm-hmm.
Those are people that have taken companies public. That's their first company that they took public. And, once they did it once and they go a second round, a third round.
And so you're thinking that this might take place next year or the following? And so this is the year 2021 where these folks might consider gifting or transferring some of the assets that they have?
Yes. They're really going to push on this.
Mm-hmm.
I gave you the example of the attorney, $20 million portfolio tax-free.
Mm-hmm. So in addition then to the estate planning that folks should be thinking about doing this year, are there any other tips, insights, suggestions that you might have for our viewers about things that they can and should be doing this year in particular, or best practices in general?
Well, best practices is different from a tip. What I see when people come into our office and they're really worried and they have to make a decision one way or the other on a business transaction, and they're letting this tax tail wag the dog, where all of these other decisions are so much more important than the tax aspect. There's tax, of course, but that should not be the driving force in your decision making. You really should make good business decisions. You should go out and get more revenue, get more employees, make more money, pay good salaries, help the economy.
Those are always good things to do. Mm-hmm. Well, that's great. Anything else before we switch gears? Because I do want to ask you some questions about these best practices that avoid the IRS scrutiny, because I think that most people know that there's always that risk of an IRS audit, and I think people just dread even the thought of it. I know that you pride yourself, and so does everyone at your firm, with preparing taxes in such a way that you would have a no change letter or would withstand the IRS audit. Can you share some insights and thoughts on what we can do better to be more at peace if there is going to be an audit?
The tax law is complex. I talk with attorneys from other countries, and when I show them our federal standard reporter, it's pretty amazing. So if tax law is that complex, why would you use TurboTax? And so there are metrics out there now that people, these do-it-yourselfers, they are now going to professionals. And it is the people that are using TurboTax that are getting pulled in. And I can give you an example, and it's happening right now. We have a new client. He had an attorney, former IRS person, auditor, preparing his tax return for many, many years. It's a very successful surgery practice, very successful. And the preparer ended up with several strokes and was non-responsive, and it got to be October 10th. And so his business consultant, who's an MBA guy, thinks, well, we better do something. So he said, I will help you because you don't have a CPA. And this is prior to his becoming our client. And so he said, I'll prepare your tax return and I'll use TurboTax. So very simple error. The IRS has refined their algorithms. And so if you don't put the right number in the right box, you'll get pulled for an audit. Even though, they're down 71,000 people, but the algorithms are working. And so what happened is this MBA professional he's still on a Schedule C. It makes about $2 million a year, and he pays $92,000 on a credit line interest. He pays interest expense on a credit line. And so on Schedule C, something so simple, there's a line that says interest expense, but then it's divided into two boxes. The upper box says mortgage interest, and the lower box says other interest. Well, this MBA professional put it into mortgage interest. Well, automatically IRS reconciles mortgage interest with the 1098s that are sent from the bank. And so they didn't get any 1098s from the bank for the $92,000 expense. And they're saying, oh, whoa, this guy's taking a $92,000 expense and there's nothing to substantiate it. Pulled in for an audit. And that's unfortunate because this is going to stop their medical practice. The office manager has to meet with the IRS auditor. I'm not going to be really involved in this one because they have nothing to hide. They have such excellent internal controls. The office manager is outstanding. The MBA checks everything the office manager does. The problem is this silly TurboTax box that he put this number in, and it's going to cost them out of pocket extra at least $10,000 just to deal with this, and then the headache and then the stress. And so I think people that use TurboTax should think twice. If you're an employee and you own a home and you have nothing else, you're fine, and you're detail oriented and you read instructions and follow instructions well, I think you're fine with TurboTax. But anything else, I would say use a professional.
Well, that's interesting. A couple of things that you just mentioned I didn't know. One of them is you said the IRS is down 70, how many employees?
At least 71,000.
And when did that happen?
It's been happening over the last 10 years. That's why Biden wants to invest the $80 billion into the IRS, over a 10-year period of time to collect $700 billion. And that's why they're leaving the $1 trillion on the table every year. The personnel is not there.
So part of the proposal with these tax changes is to fund the IRS. It's not necessarily to generate revenue.
Correct.
For the government. Interesting. And you're saying now that even though they don't have the employees, it's all algorithmic. So we get pulled in for audit because of a computer algorithm, not even individuals reviewing.
Yeah. Yes.
Got it. Well, if nothing else, I think that's a good call to action for those of our listeners that may still be using perhaps a TurboTax or some equivalent where they may have some complexity. I mean, what would you say about some other things like H&R Block, some folks that are using these conglomerate, tax filing services? Do you have confidence in the way that they do business?
Well, it's different than the way we do business. And I was very fortunate with the CPA firms that I worked at. It's the standard was the same. And it really was, I call it a court standard or an IRS audit standard. So every number on the tax return is substantiated in the tax work paper file. Every number on the tax return goes through a review process. And then it ends up on the partner's desk, and then there's a reasonableness test. So something like this with this wrong box on this TurboTax, that would never happen in a CPA firm that has a review process. It gets picked up immediately. It's just human error. And so when you work with a firm that operates and the work product comes out at a court level, it will withstand court scrutiny. It will withstand IRS scrutiny. You've got peace of mind. Of course, the client has to work a little bit more. The CPA firm has to work a little bit more. But in the end, you've got peace of mind and you pay the least amount of tax, and it's all substantiated.
Well, I think this is a good reminder that that good professionals are worth the investment because you get back more than what you might pay them, and avoiding some of the self-filing, especially now because everything is moving to an algorithm or computer-based audit system. Yeah. Do you have any other thoughts that you would share with our viewers before we start wrapping up our conversation?
Oh, I don't know. I can talk for hours and hours.
I don't know that we have the hours,
I can
but
tell you that this is the best profession to be in. It, and I really mentor our young people. Get your CPA license. It's your meal ticket for life. If you're thinking of changing professions, consider the CPA profession. It's fascinating. I just have such a passion for it. Every day is such a challenge, and you get to help people, and you get to see how you help people, and that's really a good feeling.
absolutely is. And I know that it comes across because of the amount of time and effort and thought that you put in to working with your clients. And having had known you for a number of years, I've heard a lot of stories when you're advocating on behalf of your clients. It goes above and beyond, I think, what a lot of other tax professionals might take on themselves. Well, and that might be a good pivot for me to ask if it's okay to share your information with folks that might be looking to speak with an accountant, yourselves included. Can you tell us a little bit about your firm and how do folks get in touch with you?
Absolutely. I pick up the phone. I'm always there in the evening. That's a good time to call. I personally pick up the phone. I will always help. I will always assess. Um, I've just been very fortunate. I'm an immigrant. So many people have helped me. And I certainly, if I can help someone, that just leaves me with a really good feeling. So you're welcome to call.
So I know that you also have a very thoughtful newsletter that goes out. I get a lot of newsletters. Yours is one of the ones that I read every time it comes out because it's filled with good insights about the tax changes. It has actionable, it has links. How do people sign up for your list if they're interested in getting it as well?
Well, there's two ways. You can go to our website, and there is a contact page, and you can ask to be registered for the newsletter, or you can just send me an email, and I'll forward it on to the people that handle it.
All right. What is the website?
The website is www.slpconsults.cpa.
Okay, I'm putting that on the screen right now. For those of you who would like to learn more about Elizabeth's firm, the email is there in front of you, or the web address, excuse me, is in front of you. And Elizabeth, you mentioned folks can reach out to you directly. What is your email?
Yes, it's my name, E Schwiff at slpconsults.cpa.
Perfect. That's up on the screen now as well. So if you have any questions for Elizabeth, or if you'd like for her to send you their newsletter, which I highly recommend, please reach out to Elizabeth directly. And Elizabeth, anything else before we wrap up? Any parting thoughts?
Well, yes, but it would probably take 2 or 3 minutes. And that is the most important part. The most important part is the bookkeeping. It's really not the tax return. It is doing the bookkeeping. People that they have a business and they don't have a good bookkeeper. That's the number one. If you have a good bookkeeper, you've got your foundation.
Okay. Any others? Because I was expecting the 2 to 3 minutes worth.
Oh, really? Oh, okay.
We have 2 minutes, hopefully, folks that are watching. And by the way, for those of you who are watching live, I see that we have some folks online. If you have any questions for Elizabeth, this might be a good time to ask. And you can simply put your questions in the chat or in the comment section of the social media channel that you're on. And I'm sure Elizabeth will love your questions.
Okay, so I'm just thinking here, I just got something from a client. He's currently in Japan. He's a Japanese gentleman. People that get a notice, a taxpayer gets a notice from the IRS, from the franchise tax board, from somebody, from the property tax assessor's office, and they have a heart attack. And so I say, don't have a heart attack. Pick up the phone and call them. Find out what's wrong. Many, many times it's an error on their part, not your part. It's their problem. They didn't get something. And so, drill down and see what the actual problem is. And it is solvable. And the good thing about our industry and tax and bookkeeping and accounting is everything is actually fixable. Something was incorrect 10 years. I remember in the early 90s, a taxpayer was pulled in for 10 years of audit. Even that was all fixable. He came out with a no change. Everything is fixable.
Well, there's no better way that I can think of ending a conversation as charged as taxes with the word, it's all fixable.
It's all.
Well, Elizabeth, I want to say thank you on behalf of the Hebrew Free Loan, on behalf of our community, for being a valued Business Circle member and being a big supporter and a big contributor to the Hebrew Free Loan. And on behalf of everyone at Hebrew Free Loan and the Business Circle, to all of you, all of our viewers, I hope you found this conversation both helpful and insightful, and I wish you all well. Elizabeth, again, thank you very much.
Thank you, Roman. Thank
Be
you,
well.
Hebrew Free Loan.
Thanks, everybody.
Mm-hmm.